All right, so it's been a couple of weeks here since we last did a market outlook video. I've been on vacation, as most of you know. I've been out on a cruise in Norway, seeing the Norwegian fjords and seeing Sweden and spending a few days in Copenhagen. So we had a really good time, but back at it. And interestingly enough, the market kind of just stayed neutral for most of that time until Wednesday. On my way back is when the market decided to do something, and so Wednesday, Thursday, and then today, we have a little bit of a decline here. So the question is, what makes this decline different from all the other little small pullbacks that we've seen, kind of near-term pullbacks that weren't enough to really kind of break the dam into an actual 5% decline on the S&P 500. So we're going to show the differences there and why I expect that now we are starting that pullback with what we've seen at the end of this week going into next week. We'll talk about what's driving a lot of this action here, some very interesting moves across different asset classes, so I'll break that down, and some interesting moves in some sector rotation as well. Not the sector rotation you would have expected here, as we are getting a little bit more risk averse over the past few days. So we're going to break down that move, and then our trade idea of the day is actually on a stock that might be a couple of days ahead of the S&P in terms of where we might be headed. And we'll talk about how to trade that particular stock and how we might be able to take advantage of its weakness currently. So let's go ahead and get started. Today is Friday, August the 4th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these things over here on the right, including our Market Outlook live video that I do on the days I do the Market Outlook videos at 3:30 Eastern time. Come down to the bottom, click this heart, it opens up this tab. Hit that like button there. Same thing here, click on this icon, it opens up another new tab. Hit that like button there. Again, the more you do that, it helps get our content out on both of these platforms to all of our followers on those platforms. So we really appreciate those who do that day in and day out, and those who don't, you can do right now with one or two really easy clicks while you're watching. Well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see today, we got a bull tag on the S&P 500, which again we've had before. We've had a couple of these from back over here. This, like these other two, we're only at 0.13 of a point, percentage point below the 30-day moving average. Over here we were a half a percentage point, and then on this one we were 3/4. So this is actually the weakest one of these bull tags. You can see some of these other bull tags that actually do start these intermediate declines, because every intermediate decline actually starts with a bull tag. This one we were down 1.25% below, and over here we were down 1.33% below. This one we were down 1.5% below, and then we kept going down on all of these, which really makes Monday and Tuesday next week really important as to whether we keep dropping or whether we immediately bounce back up, which is what happened the last two times we got these bull tags, and really even this one too, which wasn't technically a bull tag but pretty much was one. We jumped up pretty significantly all three of these instances, so that's really important. Like, again, this is, we had the momentum line at extreme lows. You have the near-term line down well in the reversal zone. Again, last time we had that, we were still well above the 30-day moving average because we had been so bullish. We had gone parabolic into that options expiration in June. Here we were pretty bullish going into July expiration and have been bearish coming out of it again. But still, just 0.13 of a percentage point below. Not that significant of a drop. Looking at the NASDAQ 100, also getting a bull tag. Also just barely below, 0.5% below. Again, last time we had a bull tag was over here at the end of April. The little different this time, though, the intermediate line's actually been below the 80th percentile for quite a while. Well below its market sentiment, which is falling. Still in the upper reversal zone, but falling. And again, pretty bearish short-term sentiment. So that's a little different than the S&P, which is just now crossing out of the reversal zone. Of course, your Dow Jones Industrial Average has been more bullish, It's got bearish short-term sentiment, but you're still, you don't have the bull tag yet. You're still well above the moving average, and you're still you don't have the intermediate line still in the upper reversal zone. Remember, it hasn't been as bullish for as long. It's been catching up lately, and it's had this little breakout here on the 18th of July, and it's been holding so far. We're not, now we're almost back down to that. We're only a few points above that now of where we were at that close. But that was kind of like this has been a catch-up move for the Dow Jones, which we haven't had that same weakness in the other indexes. You can see it had this pullback in May that the S&P just didn't have there, right? We were fine. We had these bull tags, but we never did get the pullback. And then finally, your Russell 2000, which also had some weakness in May here in early June. Really been catching up, but not breaking up above these highs like the Dow did. Got up to those highs and kind of got a little bit above that last week or the 31st, whenever that was. And then wasn't able to hold that breakout. And again, we don't have the bull tag yet because we're still easily above the 30-day moving average. And short-term sentiment is actually not that bad. This is actually the weakest bearish short-term sentiment that we have right now. The intermediate line still in the reversal zone. Market sentiment now has finally gotten into the reversal zone. So looking pretty good. Those two indexes looking pretty good. The NASDAQ and the S&P are the ones that are struggling. On a weekly chart, you can see a pretty significant candle on the weekly chart. If you look at like how much we've fallen here this week, it's a 2% decline for the week. We haven't had since that March banking issues, and we had a bearish week going into that at the end of February. So it's been a while since we've had a 2% decline on a weekly basis. Of course, even on a daily basis, we had our first 1% decline earlier this week on Wednesday, and we didn't really follow it up with very much. I mean, these have been two pretty small down days, both less than 0.5%. Even with today's move that started off with a gap up to the upside there. So when you look at the S&P's market forecast on a weekly basis, it is a pretty bearish week. Again, that March issue was right there, and then there was the week before that was also a 2% decline. You don't, these intermediate declines, you get, these 2% pullbacks even on a weekly basis. And that appears to be what we're getting here now, the beginning stages. The momentum line is at extreme lows. The near-term line is out of bullish territory now and working its way down towards, with this divergence pattern, working its way down towards bearish territory for the first time since that last intermediate decline. So this chart would suggest that we are due like next week to really start this intermediate pullback. That we've been kind of in transition mode towards for the past few weeks. We've been in this convergence mode where we've maintained bullishness, but kind of more of a grind higher. Your NASDAQ 100 also had a pretty down week. Remember, it wasn't so bad that week in March, but we were still above the moving average. So since then, this has been the biggest decline, and the same short-term sentiment applies here. Very bullish intermediate line. But your momentum line dropping below the 5th percentile, your near-term line dropping out of bullish territory, close to bearish territory. You're 13% above the moving average, which is still a pretty high level, relatively speaking, when you look back, over time, as far back as we can go here. So we're 13% above. Look at where my cursor, follow that line across. It's not too often, coming off the COVID lows and coming off the 2009 lows, it's not too often that we've been that we're this bullish, we're this far up above the moving average. So not surprisingly, start to get some profit taking and losing some bullish momentum. That's a hard move to maintain. It's a hard kind of move to maintain. Now, 2 weeks ago, we did get a cluster on the Dow Jones Industrial Average. Remember, it wasn't nearly as bearish this week. That was the breakout week. But now again, short-term sentiment is strongly, at extreme lows on the momentum line. The near-term line still hasn't fallen out of bearish territory, so you might still be a week behind on the Dow. And then your Russell too Again, you got a divergence on the weekly chart on the Russell with the near-term line there, and you can see the near-term line crossing below the intermediate line with both of them below 80, suggests that it's unlikely the intermediate line will be able to stay strong enough to get above 80 and then stay above 80 there. So, which is what happened kind of over here, where it dropped below the intermediate line with both of them below 80, and we were unable to maintain that bullishness, which happened to be the last time Apple and Amazon had their earnings, and then it faltered after that. You would expect we'll probably see some kind of similar pattern here. The weekly chart is showing a transition candle. It ended up being a bullish candle, but we are below the moving average. But you did get a lower close. You got a high and an upper and lower shadow. So this is a transition candle. No red arrow yet on that 10-week exponential moving average. Same thing on the NASDAQ. You did get a transition candle. It was a pretty bearish candle when you look at the regular candle there, which suggests that this will transition to some bearish candles now. We'll see if we get that red arrow. You would expect we'll get a red arrow on the 10-week exponential moving average. That PPO there on the weekly chart between the 10 and 40 weeks, you can see, again, it's pretty darn high. This is the NASDAQ, has been very bullish, relatively speaking, compared to its prior history here. So, it's hard, again, like I said before, it's hard to maintain this kind of parabolic move that the markets have been on. We'll talk about that more in here in just a second. If you take a look at the three red arrow charts, the NASDAQ and the S&P actually do have three red arrows now. Again, like if it's only a one-day thing like it was before, then we'll bounce right off of this. If it turns into a 2 or 3 day thing, which is why Monday and Tuesday next week are so important, then we're starting an intermediate run. And that's the camp I actually believe that we're headed towards. I think this is the beginning stages of the intermediate decline, that you'll start to see the Dow and Russell move into that stage next week. If you look at the two-line versions of this, you can see we have been now below the 17-day moving average for 3 days, with the MACD really breaking down way below its moving average, working its way towards zero. It hasn't been below zero for quite a while, since the last intermediate decline. The stochastics dropped below the 40th percentile, barely, but it dropped below the 40th percentile. So again, more bearish than what we've seen on the S&P during this all these little tiny pullbacks that we've had. This has obviously been a lot more bearish. You see that reflected in the whole moving average turning south, right? The whole's turning south here. The parabolic SARS flipped up on Wednesday. The MACD is below its moving average when you look at where we are relative to the 200-day whole. All bearish signs. You can see the size of the candle was big enough to start intermediate declines. Now the last couple times, they weren't able to kind of get going there, but this time we have some other patterns that are corroborating that we've been pointing out here. Looking at the DMI, you can see we have been in convergence mode with the positive indicator well below the ADX, but now we're so bearish on the negative indicator. Now it's really popped up. The positive indicator has plummeted. So things are changing on the DMI pretty dramatically. The RSI and the CCI are also dropping. We're below the midpoint on the RSI. We're below the 150 for a second straight day on the CCI. So we're not out of bullish stages yet on these charts. We have to drop below minus 100 to end this bullish stage in the weekly chart. So we're not quite there yet. But we are, we're definitely not nearly as bullish as we have been. That's a pretty not the best finish to the week for the market, for the S&P. Breaking below the blue line, again, for the first time in a while, since the last bull tag that we got in the last 3 red arrow pattern that we got back here at the end of May that led to this run. We still have a strong bullish trend, so we haven't hit zero yet on the trend quality or noise balance. We have on the NASDAQ. See, we have hit zero. And you still have a positive rate of change, but that's a big change for the NASDAQ, and you expect you'll probably get that on Monday here on the S&P. Your diamonds, remember, never did get up to that mature, kind of barely did. We are below the green line there, and then IWM's the same thing. It did get above the 5 and 80 marks, which are mature bullish trends. And when that happens and you get below the green line, that's your convergence mode. That's when you're kind of done with the bullish impulse move. So a lot of these indicators are suggesting things are turning around. Look, we're in the lower half of the bandwidth, not in the lowest quartile yet, but we are in the lowest half. The momentum is definitely waning as the bands are moving back inside the Keltner channels. We'll get some red dots here again, probably again either Tuesday or Wednesday, which would, last time we didn't quite get the trend change because we turned right back around. But this time we're below the moving average, right? This time we didn't get below the moving average and we got those red dots, and now you expect that we will. If you look at the breadth has been pretty bearish. You can see, we were easily below zero the last 3 days, so things have changed pretty sharply in that regard. As you notice, when you look at the, here, where did it go? Sorry. Give me 1 second. There we go. So when you look at the number of stocks below the 200-day moving average has dropped pretty sharply. Still above 300, so it's not like it's still above the 60% mark, which is what the 300 mark is, but well below the moving average. The moving average got actually higher than it did in February. So, we have been pretty strongly bullish, and that's changed. The breadth is gone. We're really close to flirting with that 60% level on the 50-day moving average and plummeting below the moving average for it. And it did not get as high, or got about as high as it did last August and here in February, or at the end of the year for the S&P. And then if you look at the new highs and new lows, which is another measure of breadth, flirting with positive levels once this gets updated with the NASDAQ composite, more than likely will end up being negative again like it was the last couple of days. So, but either way, well below its moving average. So the breadth has gone. The money flow index that we look at in conjunction with that breadth is also turned south. It's well below 50, is flirting with getting below into bearish territory there. So the breadth has really come down pretty hard. If you look at the last time we were at these levels for breadth, we were higher than we're at right now. So like the breadth, the money flow is pretty strong on the downward move. And we'll see if that continues to translate into more bearishness, which, like I said, is what you would expect, as what I expect going into these next so many weeks. Let's look at today's intraday move. It was a higher high, but a lower low, and we closed below yesterday's low, easily closing below last week's low. So, and we're actually below the value area of the past 4 weeks. So we are kind of in this mode where there's not a whole lot of support, which makes it, again, a lot easier to go down than go up on Monday and Tuesday. Doesn't mean we can't, but that's another reason why I expect that we'll be, just as bearish, probably, and filling in. We filled in a lot of this gap from the 13th, but probably we'll end up filling in a lot of this gap from the 12th early next week, if not Monday, then Tuesday. So you can see the Arun indicator as the green line has dropped below 70. Obviously, we've been at zero for a long time on the negative indicator. So we are set up for a breakout to the downside, for a new 4-week low to develop. Now, again, for a couple of days, the 4-week low is going to be down here. But by the end of next week, the 4-week low is going to be way up here. In fact, this would be the new 4-week low point by the end of next week. If it holds, right? If this ends up being, so next week we're going to get a new 4-week low point, as whether it's going to be this one or any other new low we get throughout the next week. You see that on the spiders, on the Qs as well. The Qs have been even more bearish because the green line is not only below 70, but it's well below 50. So, and you can also see too, there's that gap from the 12th that we are, the 13th now has filled in, and the gap from the 12th is very likely as we are also below the value area there. And again, the low point will do the same thing the S&P has done. So we are set up for a bearish move to develop next week, with the beginning, which we're in the beginning stages of here today with these patterns I've been discussing. The volume was well above average. In fact, even stronger than what we saw on Wednesday. So 100 million shares trading hands, way above average on the range. This is a very big range, not even having to include the gap there. So both those numbers are bringing both of these charts to the upside. And when both of these, the ATR and the volume start to rise, see 110 million is way up here. When both these lines rise, they typically coincide with bearishness, as you're almost back above. The ATR has been rising back up. It's almost back above 1%. So things are turning south in that regard. And then finally, if you look at the VIX ratio, the VIX really jumped up at the end of the day, big time jump to finish above 17 and above the 90% mark. So one of the higher closes at the end of a week that we've seen in a while. In fact, it's the first time we've closed at the high of the week since who knows when. It's really over here. These April weeks where we closed at the highs in 2022. Well, actually, it looks like 1 week here we closed near the high in August of after the Jackson Hole event. We closed at the high of the week. You see how rare it is to close at the high of the week. The VVIX jumped up to new highs. The VIX is jumping up to new highs. The VIX itself closed up above its 50-day moving average and well above its 50-day moving average. And now the 8 and 17-day are about to cross up above the 50-day. Again, they haven't done that since the banking issues that we had there in early March. So things are turning south for the markets, and I think we're just kind of getting started here the last 3 days of this week. So maybe that settled vacation indicator didn't work out while I was gone, but it's certainly starting to show the signs of working out since I've been back, these last couple of days since I've been back here. All right, now let's take a look at what's driving a lot of this price action. As you can see, it's, again, the returns that we've been getting over the past few months, even if you go out 6 months, have been very strong returns for the Qs and very weak returns for just about everybody else. The S&P kind of lifted up there. IWM has been down over the past 6 months. Real estate has been down over the past 6 months of REITs. TLT has been down, obviously, over the last 6 months with the rise in the yield, especially here lately. The dollar has been relatively flat. Let's take a look at just today alone, and we'll zoom out to what we saw this week. Oops. So we'll go to August the 4th first. So today, you can see we were doing all right. Yields were down. That really helped stocks do well. Stocks benefit, right, when yields are down. But things took a sudden turn as soon as Europe closed for the worse, and stocks ended up closing near their lows of the day. You can see it wasn't just stocks. It was the dollar has been down for most of the day today, which is generally positive for equities. But again, at the end of the day, things change. Real estate also struggling. Gold ended up outperforming equities. Commodities were bullish. High yield bonds were actually up over equities, though they underperformed treasuries pretty significantly. So that was kind of an interesting close to the day. If I zoom out to the week, and remember that really things turned south here on Wednesday. The stocks were pretty flat. The dollar was really bullish all week long until today. So a little profit taking today. Yields were really bullish all week long until today. They were down today. But look at that move on TLT, down 5% at one point this week. So if you take a look at how that translates to like what the 10-year yield did, and TLT is not exactly the 10-year yield. There is some correlation with that, but there's the big jump that we've seen in yields over the past couple of weeks, really, getting up to a 4.19% essentially yesterday before dropping down about 13 basis points today, the 4.06. Obviously, having the same impact on its market forecast that the S&P has been having. But what's interesting is the dollar did not have as big of a decline. It was down 0.5% today, but you can see just how bullish it's been. Its near-term line also dropping below its intermediate line, with the intermediate line below the 80th percentile. So again, suggesting that there might be some bearish moves in the dollar going forward. We'll see if that ends up being the case, or if this is a one-day phenomenon. Remember, TLT is the other side of that coin of rising yields. TLT has had a couple of clusters here on the daily chart. Almost finished the week with a cluster. In fact, had a cluster for most of the day until this little rally off of the lows that we saw today, or most of the week, excuse me, until the rally off the lows today. So now you can get, clusters of clusters, so it's not just a one-time deal, but you can kind of see, even if we did avoid the cluster, they're still all below the 25th percentile, including market sentiment, which is just barely above the 20th. So things are pretty oversold on a long-term basis on TLT, even if they've been pretty bullish here, today, and even if it's kind of gone a little parabolic in the last week or so, last couple of weeks, to the point where you can see its DMI has really shot up above 40 for the first time in a while. It didn't even shoot up above 40 this much during the whole bearish move last fall on yields. So pretty unique move that we've seen that, like I said, has produced a couple of clusters on TLT and the rebound that we saw today. Let's take a look at a couple of these ratio charts. Let's go to the Qs relative to IWM. That's been a ratio that's obviously positively correlated with risk appetite in general. You can see we're at 75th percentile. It's on a weekly chart. Let's go to a daily. This is on the daily chart. So you can see it's mostly positively correlated, even if that correlation has come down just a little bit here lately. But if you take a look at what we've seen on the daily chart, we're breaking down. The last couple of weeks, we're breaking below the 50-day moving average. There's a huge gap to fill between the 50 and the 200-day moving average. And usually when that fills, that's not generally bullish for equities. So we'll see how that ends up playing out. We've been able to maintain some bullishness until the last few days. That's why this correlation has dropped from 75% to just below 50. But again, that's not generally bullish for the markets when this ratio is dropping as hard as it is. If you look at the credit spread versus high yield and treasuries, you can see they're also starting to show some weakness below the 17-day moving average, with the MACD turning down. The long term very strong, so we've got some opportunity for some selling here, and that's on the high yield end. If you look at the investment grade end, kind of a longer term duration, we've already broken below the 17-day with the MACD breaking down, so things are already turning bearish on this ratio as well. Some other ratios, for example, the consumer ratio of discretionary versus staples before the Amazon result today had been breaking down as well and flirting with that 50-day moving average, which again, it's been making such a good move since really the beginning of the year, but had been breaking down again. This is all Amazon, and now the question is whether or not Amazon will be able to maintain the move that it's had today. When you look at its chart coming off of its earnings announcement, we've seen this before. That's what happened on the exhaustion gap on the second. It gapped up to the upside. By the next day, it had more than filled in that gap. Same thing on the last earnings announcement. We gapped up after the earnings, and we more than filled in the gap within the next couple of days. So if we're going to fill in this gap, that's a lot more to fill in, especially considering Apple, which is another big bellwether, had announced its earnings, and it gapped down and continued down. So down 5% today. The intermediate line falling out of bullish territory with some extreme bearish short-term sentiment, down 5%. So we got the bull tag yesterday on Apple and followed through with that with the drop to the downside today, suggesting that we're probably starting, like we did last time we got this bull tag, a new intermediate decline to the downside. And that's not very bullish for the markets, as considering this is the biggest weighting in the S&P and still even in the NASDAQ 100, of course, despite the rebalancing that the NASDAQ 100 had. Let's look at how the sectors have performed. Again, let's look at just this week alone. So let's go out to August, and then we'll go to like take a 5-minute chart here. And you saw, again, most of that weakness in the last few days. Look at energy rebounding, but utilities, with the rise in yields that we've seen this week, utilities has put a lot of pressure on utilities there. They're down big time, over 4.5%. XLK is down almost 4%. Again, a lot of that's Apple today, but you notice it was down already here on Wednesday and Thursday before we even got to Apple's earnings. And then, of course, discretionary was also down there with communication services before today's Amazon news. But you see it's well off of its highs. I expect next week Amazon to fill in that gap and discretionary to fall back down to where these other two are as well. Energy doing well. So not the most risk off pattern because you didn't have, really no safety trade. Energy was your biggest winner because of the move higher in crude oil prices. But that's not necessarily considered a safety trade. It's actually considered kind of a late cycle bullish risk appetite type trade there. Let's look at the 12 grid for these sectors, which have been so bullish before I left, right? They were all dark green shading, green lines. That's not necessarily the case now. You got a lot of light pink shading showing up. You've got a few real estate here. XLK with yellow lines. Utilities has dark pink shading and a red line already. Again, that's the impact of rising yields. And then you can see some of these others still have dark green shading and green lines as they're all approaching their moving average here. This is that other cyclical area. So the ones up top are all kind of light pink shading and yellow lines. XLC is the one that's not quite there for the yellow line yet. So bull tags on these two. And then down here at the bottom, safety elements are also doing very poorly. So it's interesting that, we've talked about before, these mega cap names have become kind of safety trades, and they're all behaving similarly, while the cyclical area of financials, industrials, materials, energy, kind of late cycle cyclical area, they're still holding up. They're down, all except for energy there. They're down, but they're at least holding up better than, these mega cap bellwethers are holding up, as they're all start showing more weakness, the type of weakness that would suggest that the broader market as a whole is due to start this intermediate decline again as early as the early part of next week. All right, now let's take a look at our trade idea of the day, and I want to take a look at Take Two Interactive. You can see it also has a bull tag, got one yesterday, and it followed through that move with a 2.5% drop today. Intermediate line dropping, close to dropping out of the reversal zone. The last time it got this low was the last time it had a bull tag, and it bounced up, and you can see the bull tag over here got a little bit below, but still above the market sentiment line. Now market, short-term sentiment's pretty strongly bearish. We're dropping, we're below market sentiment. We're 4% below, which is the lowest level we've been below since the last time we had an intermediate decline on the stock. So things are turning south for this stock, kind of what you expect the broader market to do early next week. If you take a look at its weekly chart, you can see it's also a transition candle, though it did go bearish, and it's got a red arrow. So that's kind of what you expect, again, that we'll see next week on the S&P, and you can see we're already getting it here on the stock. We have have had 3 red arrows now for 3 straight days. Doesn't look like we'll get a green arrow anytime soon. So we're going to be pink shading for a while, which again indicates the beginning stages of an intermediate decline for the stock. If you look at, we are breaking below the 50-day moving average. We broke below the 17 and the 30 on Wednesday, followed that up with a down day yesterday and inside the gap between 30 and the 50, and then breaking the 50 today. MACD has gone negative, stochastics in bearish territory down there. All the other oscillators are also showing bearish breakout patterns. The DMI is the negative indicator crossed up above 30, the positive down below 20. So that's a pretty strong level there. The RSI and the CCI are also showing bearish breakdowns below 40 in the RSI, below minus 200 on the CCI. Looking at the Ichimoku cloud, we are well below the blue line now, easily. In fact, the green line is about to cross below the blue line. No trend, the bullish trend is gone, and we have a negative rate of change. So again, kind of a couple of days past where the S&P is now. So again, that's kind of what you expect to see potentially on the S&P next week. and then breaking below the lower Bollinger Band. So, a couple of days ago we were in that not quite the lowest quartile there. So again, on Wednesday, about where the S&P is now, and then you can see in 2 days you're breaking below the lower band, breaking below the lower Keltner channel, and you've gone from positive to negative momentum while you still have red dots, which most likely will get green dots on Monday. So things are really turning south for the stock. So what I decided to do here was say, okay, let's do a long put vertical spread for September, buying the 135 put at right around the 30 deltas, going one strike away. For the short, position sizing like we normally do. So we position size half of what we normally do since it's a low probability directional trade. But getting a 3-to-1 reward to risk ratio if it works out, and a little bit of flexibility there if it doesn't work out immediately. While you have you have that much room to go to get before the maximum gain is outside of the 1 standard deviation window. So a lot of room to work with and a pretty decent reward to risk ratio on top of that. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel. Hit that thumbs up icon. Comment on our video. Also, join our website at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.